A very good morning to you, folks. Welcome to Wacky Wednesday. More fun and games, no doubt. No Still this morning. He's off running some errands. So just me and the K-Meister. Morning, mate.
Hey, hi, Ryan. Hello, everybody.
Hello. Hope everyone's doing well. Not a great deal happening this morning so far, but still remains lively in a few pairs, which we will get to in due course. Let's kick it off with our old mate Ueda in his third parliamentary appearance of the week. This time he says that monetary easing is not aimed at funding government spending. Consideration towards the government's debt financing cost won't constrain necessary monetary policy moves. Japan's cost push inflation is peaking out, and a policy response is difficult during cost push inflation. Now, I know Kay and us have mentioned that he's in overdrive with the comments at the moment. These are comments in Parliament, so he's obviously been summoned there for various reasons, and then he's responding to questions or making statements there. But what is of note is that they are covering all the different subjects at the moment. We heard how easing is going to continue, and that the conditions aren't there yet. We've heard that from the Finance Ministry that consideration will need to be made if the Bank of Japan tighten regarding debt issuance and the like. Now we're hearing from Ueda making a distinction that keeping monetary policy separate from government funding and spending, and that the problems a government may face will not necessarily impact what they decide with monetary policy. So again, this is an exercise in, I would say, detailing the different conditions and setting the stall out in terms of what the BOJ will do regarding monetary policy. If they move to tightening, they won't be worrying too much about what that effect has on the government. That's for the government to solve. They won't ignore it, obviously, but all these little comments that have come out are pretty much covering a lot of bases in terms of a possible tightening cycle. So that's important going in, because it is pushing us towards the BOJ exiting, whenever that may be it they hint at something in this meeting or we don't get anything till later in the year. The mood, the sentiment is switching towards when they exit, whereas you take it 6 months, a year ago, no one was really even thinking about a possible exit on that side. So the oil tanker is slowly, very slowly shifting, minutely, I would say. What do you make of those comments overnight, Kay, yourself?
Well, I think it's a pretty good sum up of what's going on. We've been saying over communication. For the time being, it looks as they will, for this meeting at least, keep everything in place. But again, they, as you rightly say, they are preparing more than the markets. They seem to be preparing the government, saying like, all right, guys, if you want to fund yourself cheaply, you might be wanting to start to think about how you are going to do it. And so that again, I don't know whether it's really the reason why the yen is stronger today, but it does it does fit in the framework that I've been talking about as well, is that they want to prepare everybody to make the transition as smooth as possible, but it remains the base case that they are going to try to normalize. So, and by over communicating, they want to prepare everybody, and especially the government, I'd say now, to try and do something about their finances. So yeah, it's interesting actually, this communication exercise.
Yeah, definitely. And I think looking at it from a big picture, you've obviously been watching and trading the BOJ for years. I have as well. I don't think we've ever been as close in reality to them changing from easing than we have at the moment.
Absolutely.
And even that, we're still miles away from it.
Well,
I would expect by the end of this year, they would have switched to the path in one way or another.
Yeah. And I think this meeting, we shouldn't be surprised if they talk about stuff, right? Keeping everything in place, but we shouldn't be surprised if they actually talk about things. And I'd say from June onwards, I think the next meeting is in June, if I'm correct. From June onwards, we should really be prepared to see them change something. And that well, I think the speculation will be rife by then for changes, or at least embryonical changes. Yeah, so it's going to be, but it still remains my base case that it's going to be much slower than in any other of the major countries. And the way that central banks handle it is going to be much slower, because they just can't let everything go, because that's going to create mayhem in the markets, and not only the Japanese market. But we really should prepare ourselves for some normalization in Japan.
Yeah, very much so. And just today, and obviously things can change depending on how markets move. But if we look at something like dollar yen and what's going on, let's just see if I can do this without messing it up. If we look at what's happening in dollar yen, oh, see, I messed it up. Back there, there we go. Let's get in that one. We're doing a lot of yield following at the moment. And so what's happening in dollar yen right now isn't really reflective of any sort of fundamental things going on. So we're pretty much on the yield bandwagon, and we're moving because of that. I think we would be a lot lower right now in dollar yen if it wasn't for the BOJ coming up, such as the risks both ways. But if we look at the broader picture, if we are heading towards the Bank of Japan coming out of easing policy, any dovish remarks are going to be short-lived, because the market is going to say, okay, fine, you're being dovish this week, you're sticking to policy, no changes in language or whatever, but that's not going to last. The expectation ball is going to get rolling. And if we're going to see yields in the US and elsewhere doing what they're doing, i.e. coming down, that's going to keep selling pressure on yen pairs. So what I'm saying is there's more reasons stacking up why yen pairs go down than going up. So if we do get the market rallying dollar yen on the Bank of Japan on Friday, I don't think, given the price action and all the other assets and everything else going on, I don't think that lasts. I think that rally will get sold until something else changes. Now, that being said, we get good GDP out of the US and a couple of good data prints, and we know the short-term sentiment can swing right around, and suddenly the dollar's bid and yields are up again. But even then, in the bigger picture, we can't maintain gains in yields at the moment. We can't maintain gains in the dollar at the moment. So the sentiment is definitely dollar bearish on that side of things. And as mentioned, if the BOJ are heading towards some form of exit, then that's going to be bearish for yen pairs as well. So all the bricks are stacking up. Why, in my opinion, and my trading, why I'm short dollar yen and happy to stay that side of the trade for now. But we shall see what happens, as we like to say. Coming back to, let's put that back on single.
Just about this yen, I think we're already seeing a part of it in the yen crosses, right? The dollar yen is some kind of a vehicle, because, as you say, yields have been coming off. Yesterday, equity markets were lower as well, and that is weighing on yen pairs. But I think as well that the market is going to. It's a bit like the inverse of what's happening for the Fed. The market is going to try and fight the Fed, or has tried to fight the Fed for months, and now I guess we are going to be in the scenario where the market is going to anticipate the Bank of Japan for the months to come. So yeah, I think you're right. I don't know really about the dollar side of it. The jury is out on that one, I reckon. But at least if you look at all the yen pairs, they are trading pretty weak, right?
Yeah, exactly. Well, all for their different reasons. Today, particularly, Aussie yen is one in particular. The reason that's looking more softer than elsewhere is because of the CPI numbers out of Australia yesterday, which I shall pull up for you here. So pretty significant dips in CPI. Headline CPI coming in at 7%, slightly, well, a pip higher than the 6.9, but still down a big chunk from last month. The core measures as well, all coming in lower, well, some of them coming in lower. And that's given Aussie a bit of a, or rate expectations a bit of a kick, keeping the RBA probably more on the low to poor side of the fence at the moment. Certainly there's no additional inflation and pressures there, why they may turn a bit more hawkish like the RBNZ did. So that keeps them, as I say, on that side of the street there. The Riksbank, they hiked by 50 pips as expected to 3.5% and indicated the rate will be raised by 25 pips in June or September. Is that a less hawkish move there from the Riksbank in terms of their forward guidance, Kay?
The less hawkish side in there is two things. There's two dissenters, Floden and Breman, who said that they would only they only voted for 25 BPs. And then there's something really strange because they hiked to 3.5%, saying that June or September they should do another 25. Okay, perhaps that could be non-hawkish because they announce perhaps the end when they will do that. But then they on their projections, they still foresee the interest rate to be at 3.2% in 2023. I don't know how you explain that. But anyway, the market was hoping for a very hawkish report. Didn't probably see what it wanted, and the stock lost 1% in literally 10 minutes or so. 10 minutes later, it was 1% weaker, the Swedish krona. So where the Riksbank said that they would prefer a stronger currency, they will have to do something else to prop up the Swedish krona.
Yeah, definitely. Moving on to the ECB, and Econostream was out with one of their sources pieces saying that ECB insiders are generally seen tilting towards a 25 pip hike, but are very willing to discuss a 50 pip hike. Now, what I've seen of these guys is their sources seem to be on the dovish side of the fence that they speak to. So usually the sources pieces are coming out with a little bit of a less hawkish slant to them, but puts it in the mix that maybe we're not getting a 50. Rate expectations at the moment lean towards a 25 at around 82%, with a 50 priced at the balance of 18%. I think it's a bit closer than what those estimates or those probabilities are saying regarding the 50. We know they're going on about sticky inflation. We shall find out next week, one way or another. ECB's Wojcik said that the ECB has no choice but to raise rates further. Over to the Bank of England, and BOE's Broadbent said there were signs that wage pressures are starting to ease, but they're not easing enough just yet. And BOE's Peel caused a bit of consternation here in the UK, with big headlines saying people in the UK need to accept they are poorer. Not exactly communications masterclass there from Peel. But the point he was making is pretty sound. He's saying that inflation is making the UK as a whole worse off. There's a risk that monetary policy does too much. Recent events have moderated the calls for higher rates, and UK inflation may dip below 2% in 2 years. So that's caused a bit of a stink here in the UK in the presses by you know, no one likes to hear that they're being made poorer. Even if the sentiment behind it is correct, that obviously inflation erodes earnings, income, it does in effect make everyone poorer, but it doesn't need to be put in those terms. I don't think so. It was a bit of a communications hash there, perhaps. Maybe a little bit of spin on what he actually said via the news wires, which we can never rule out. Coming over to the US, and we got some more data. The Philly Fed data came out. Where am I? Lost where I am. There we are, on Tuesday. Well, I'm trying to point it out, but it's not on the calendars anyway. So Philly Fed Services Index, or non-manufacturing as it called, came out, and it came in as a much worse, minus 22.8 versus minus 12.8 previously. Some of the components underneath, a bit mixed. New orders were down a chunk, minus 23.9 versus minus 15.4 prior. However, employment rose to 11.5 from 3.2 prior. Wages and the costs associated came up stronger, 39.7 versus 25.1 prior. Prices paid were off a little bit, 35.7 versus 37.9 prior. So overall, a bit of a drop in activity in the services sector for the Philly Fed. It is only a small regional number, but one the market likes to keep an eye on. And it also highlights potential stickiness in wages, aka inflationary pressures. So we don't get the ISMs until next week, I believe. The big ones next week, along with the next NFP. So next week's going to be a big old data run. House prices in the US as well, still looking okay, but what I am noticing is that the year-on-year numbers are drifting lower. The F.A.C.E house price index came in at 4% year-on-year, down from 5.3%, though it was up on the month 0.5%. Same with the case Schiller numbers there. Year-on-year for the 20 city number, only a gain of 0.4% over last year's 2.6%, so a bit of softness there. And the national HPI as well came in much softer at 2.05% versus 3.79% prior. So as I say, house prices still on the up, but the gains are decreasing. If we start to see some negative numbers creeping in, that will flag some potential problems in the housing market, a bit like what we were talking about yesterday with PPI numbers. If we start seeing negative numbers there, that affects on inflation. So these little clues is what I look for in the fundamentals, just to see if there's certain sectors that may be starting to flag some problems that will then feed through into what we know for the Fed and expectations and all that sort of thing. Consumer confidence came in at 101.3, missing expectations of 104 and down on the prior month. The 1 year inflation expectations, not too much of a change. It came down to 6.2 versus 6.3% prior. What that again tells us is that there's some stickiness in inflationary expectations from the consumer. And the last bit of data was the new home sales, which came in a solid 683, beating expectations and higher than last month, and also the prices component in that, also a small up on the year prior, so nothing flagging any problems there as well. You can see also some other smaller regional data there from the Richmond Fed, both manufacturing and services coming in worse than expected. So maybe some wobbles we're going to be seeing in there. As we know, this month, the numbers have been up and down between the regions. We saw Empire up in manufacturing, Philly Fed down in manufacturing. We saw the S&P Global up in both manufacturing and services. Now we're seeing some other numbers up and down, down and down. So a bit of a mixed picture going into, as I say, those main ISM numbers next week. On the rate front, yesterday, Fed swaps were no longer fully pricing in a rate hike by mid-year. So coming down in the pricing there for what the Fed are going to be doing. Again, that's what I think is feeding into the yield story, the lower yields, the market getting less hawkish on the Fed. Rate probabilities for the Fed are 84% for a 25 pip hike next week, and unchanged is the other side of the trade at 16%. First Republic Bank is looking closer to its let's call it a fire sale. They're looking at shedding up to 100 billion in asset sales. They're also potentially looking at laying off 25% of their workforce. So there's still a few bank worries floating around at the regional levels down there. And on the bank stuff, the Fed are going to release their SVB review next on the 28th at 11 a.m. Eastern time. So we get to hear what they fucked up in terms of that shit show. Google, they had their earnings out, which were pretty decent, but they are saying that they are going to meaningfully slow the pace of hiring in 2023. Obviously, one of the big hirers in the tech space, so that may not be good for the jobs market moving forward. Microsoft was also out with earnings and pretty good looking as well, beating of expectations across there. And the old fogey Biden has announced that he's going to be standing for re-election next year. Okay, any comments on any of that stuff?
Yeah, I hope he recalls that he's going to run for president.
Yeah, this is not. Wasn't unknown, but just a confirmation. He's looking like Trump's.
I hope he will remember. He
will remember. Yeah.
Now, the one only other thing that I saw was a little bit of news or projects in New Zealand, where they are trying to bring down some loan to value demands, and which may stem the housing slump a little bit over there. And there was another one as well that I saw, but I just forgot now where exactly it was. And yeah, but that's just like a Goldman warning that the quants are out of ammo for buying stocks. So I don't know. They must already be short themselves, S&P, which is a bit of a bummer because I'm short. I sold it yesterday, but anyway, yeah, it's coming off a little bit as well. I'll have a look at the S&P in a minute. No, for the rest, I haven't seen really anything in particular. You've said most of it, really. I don't see anything else on the Aussie front. The only thing I would say that what we are seeing this morning is clearly, if you look at the currencies that are moving, you got the yen on the one side, you already mentioned, which is probably a mix between yields lower, stocks lower, and so risk lower, and perhaps a little bit of that Bank of Japan speculation going on, whether it's now or later, the expectation of normalization. But I reckon that's going to increase once we are past the whole run of central banks that we will have in the upcoming week or 2 weeks actually. Excuse me. And then yeah, the rest is we are trading value date end of month. And what we're seeing this morning is very likely, once the yen did this move, the rest is really euro and sterling versus the rest of the world this morning. And I guess that is the European asset managers rebalancing books, further rebalancing. Euro has been very beat over the past month. Sterling actually been a bit of a laggard at times, but then it has the tendency to hit back relatively quickly. We've seen the euro sterling yesterday trying to break out and then coming back, and then cable finds it really tough to stay under 124 right now. So I guess either it's also month-end related, but as of what I've been saying over the past weeks, really, I find sterling having quite a bit of, I'd call it elasticity, being able to bounce back relatively quickly. And I find it a pretty interesting development. So I'm keeping a close eye on what's happening in the sterling. Perhaps tonight, if value date month end gives us what we usually may expect, perhaps there's a bit of an opportunity to buy cheap sterling, perhaps. I don't know. I'm watching the clock.
Yeah, exactly. And it's important. Have we seen any moves around the hourlies?
Yeah, it's been now.
Into one at the moment.
It's actually been an ongoing story. As soon as the clock struck 8 in Europe or the UK, both euro and sterling has started to move up. And
we're getting another one now.
Come again?
We're getting another one now. It seems 5 minutes to the top of the hour.
But now it's slowing down a little bit. I reckon the next one will be around noon, 1 p.m. and then we'll wait see where we end up in euro dollar or in the cable. But if you look at the rest, yeah, really, there's so many crosses being done that it's weighing on the Kiwi, it's weighing on the Aussie, weighing on the Canada, and on the CNH to a certain extent, and all to the benefit of euro, sterling, and yen.
Yeah, exactly. We're looking at euro dollar, and it's really trading between the levels at the moment. Keeping an eye on this, this high that we clocked yesterday, which didn't quite get as high as the previous high last week. We've had another look up there again today. We'll see what happens there. Again, this time of the month, and with everything going on, the big risk events coming up and data and whatnot, it's hard to see anything breaking out. But what you want to look for, particularly over these month-end stuff, is if prices do kick into places or areas that look like they have moved outside of the fundamentals and the general price trends going on, be they ranges or otherwise. So that can sometimes give you a little opportunity. If you suddenly over a fix, saw euro dollar spiking above 111, you might think, okay, hello, is there any real reason why that's gone there? And then maybe you look at a fade or something like that. But you have to obviously judge the moves as they come. But as mentioned with dollar yen, it remains heavy at the moment. We got below that 13.70.80 area, or 133.70.80. It's now resisting around there. So that's keeping the price on the downside. I'm hoping for a bit more down here just to give me a bit of margin over my average short price, which is around 133.65. So I'm happy that we continue to move lower. As I say, the greater it goes in my favor before the BOE, the more margin I have to play with if it rallies back up. But even so, I wouldn't be surprised even if we're trading at 133 and it's a stand pat BOJ that we don't run up to 135 again. So I'm not ruling anything out with the Bank of Japan, and I'm not placing too much faith in some of these moves that we're seeing now. As mentioned, if you look at it compared to the yield picture, if it wasn't for the BOJ, I think this would be probably down around 133, maybe under, just on the yield picture alone. So that may exert its influence after the Bank of Japan, but plenty of time until we get there. Euro sterling, as Kay mentioned, I did try a break trade on this one. I think it was the flow show I mentioned yesterday about that. Might have been a trade off, can't remember. But yeah, it looks like a typical fake out. My stop entry was pretty much bang on the high. So I got done for 20 pips on that one. I didn't give it a lot of room because I was worried for exactly that reason, that it wasn't a real move or a lasting move, and it would turn tail and kick me in the arse. So I kept the trade very tight there. At the moment, it may be that we're setting up that we're back in the box, an 88.60 60, 70 is going to be resistance again. It already looks that way with a current high at the moment. Or it could just be that we're going to wash this level out and we're just going to flap above and below, and not make much of it. By and large, it is following this old trend line that I've got running in here, which comes off from earlier in the year, from, as you can see there, just the start of February. Not something I'm really trading, but I'm just keeping an eye on it for a bit of note, because it is seemingly following that line down, albeit not exactly. So let's see if we get a move under, and if it holds under, that will maybe a bit more of a level or a bit more of a tech play than it is at the moment. But otherwise, it's the same old levels down towards 88, 25, 30s, then down towards 88s, 87, 90. So this one probably decent on the range play. If we do get another quick move above this 60 area, can it get above the next level, or is it going to just peter out once again? Aussie dollar, I know Kay will talk about this one in a bit more detail, because he's been trading it on the short side on that one. But again, the data is making most of the moves here. That CPI number there dripping out the Fed at the RBA expectations. So it could be that we're heading towards these lows back at the 65s, which may be something to look at for longs, because that area down there is a really solid point previously. And I may be looking at that area for longs as well, because I say down to that 65 is looking pretty solid. Now I was trading this run up when we got there last time, so this area is going to could be quite important, and I think it's going to take a bit more than what we've already had to really crunch that. So unless we get a change from the Fed or the RBA turning even less hawkish, this might be an area to look at. What are your thoughts on this one, Kay? As I said, you know, you've been on the short side of this one.
No, I think, well, if my hunch is correct for this afternoon, I'm ready to take profit on the shorts if we see it a bit lower. I like that area as well, 65.5. So it anywhere actually between that 65.5 and what you're showing there, it's an interesting zone, right? Yeah, we're seeing a bit lower CPI in Australia. But same as with every FX pair, the other side is perhaps not ready to ramp much higher. The dollar, I'm a bit in doubt. The dollar will have too much legs post the Fed, unless they really tell the people, okay, I mean, we are pausing, but we don't bet on us for putting rates lower for the foreseeable future. A lot can happen next week, but also looking at the clock, and as I say, that's the way I trade month end anyway. I think there could be an acceleration this afternoon, and for me personally, it's going to be an opportunity to take the rest of my shorts. Same in the Kiwi. There's a bit going on around 61 the figure, but I'll show that myself.
Yeah, no worries. Just the other one I wanted to look at, which was the dollar yuan, which I was triggered into longs yesterday and buy stops. Managed to knock some off on the way up. My highest exit was in the 94s. I left a TP in overnight, a partial TP in overnight, up at 66.50, but we didn't get close there. We pretty much banged our head on the 65 handle. The dip so far is encouraging because it hasn't got back to testing the break point. So that's encouraging, as we're not faking out just yet. I will be watching carefully if we do get a move down to that breakout point, 91, 92. But for now, it's looking like it's 50-50 whether it carries on back up, but at least we know where the next resistance level is. If we get a break above there into this old fib zone, I will slice more off and then bring my stops right up behind, just to try and lock in the rest of it. Are you? I didn't say. Are you still logging this one as well, mate?
Yeah. Yes, I'm less. How shall I say? Optimistic, or I'm a little more conservative. I've put my next one on at 560.
Yeah.
On that one. Yeah. And again, perhaps this afternoon, I don't know how it's going to pan out, but if I see some move higher and it stops short of that zone, I'm going to take more off. I'm not too sure about it's a good technical break because it's keeping and relatively easy. I think it's a decent break, and we've been in that range for so long, for more than a month, and so the break is decent, and so we should ride it for as long as it lasts, and taking some off makes the if we would get stopped on a move back down below 690.91, it's going to make a relatively free trade. So that's all the better.
Yeah, exactly. I would have liked it to move a bit bigger. I would have thought the break might have been a bit bigger. So that's just the way this pair can move. But then if it doesn't do that, you have to adjust your management and take that into consideration. And like, hey, if we see another move up to this 95 and it holds again, then I'm going to take a decent chunk off myself, because that would suggest that we're not quite ready to carry on up just yet.
I think it's still okay, especially when you look at how the majors behave. They are not. The dollar is not stronger there. It's only stronger versus commodity currencies and China, really. It's okay. We did the break. We did 0.5%. I think that's okay for a break. Now we need ideally to confirm, right? So ideally, actually, if we could take some off this afternoon, would be great. Then see a retest of that 691 and hold, and then we can perhaps start to move higher again. But that's of course to be decided.
Yeah, no, I think you're right. I think if we get, like you say, if we get a move up, take some off the table. If we get a retest to that 91 and it holds, we can reload and see if we can get another go, have another shot at it. Right, do you want to do your thing?
Yeah. Let's do a thing.
Do your thing.
S&P. So yesterday, people in the room know it was banging too much on that on that 41 10 15 for my liking. So gave it a little go. It was actually pretty timely entry, that one. It hung around there for half an hour, and then we saw the break once the New York market got running well and truly. So we saw the break. We again saw a quick test of that low 40.70s, which again is holding. So we'll have a look at it this afternoon to see if we get a retest of that 41 10 15 zone. I've taken some off. In the meantime, my stop is already at the original entry, because if it goes back above 41 10 15 20, it's no real reason to keep a short, I think. But yeah, this afternoon could be an interesting one. We could see a move or at least a retest down there. Why not go back to 40.50, and if worse comes to worse, we do have a bit of numbers this afternoon, but I'm not sure if the durables are really of that size to be able to trigger more negativity into this market. But at least if it would ever continue to go south, and I think the big level should be around 4K, right? That is your level on the downside, and for the short term, as I said, keep an eye on that 41.10, 41.17 or so. If it goes back above, not too much reasons to be short in this one. What is worth noting is that we've been telling so much about, or so often about correlations. And when yields go lower, it's good for equity markets. But I think the market is a bit worried about the state of the economy, the state of the companies. We're seeing regularly those second line data coming out and being a bit weakish. So that is typically a market where risk can come off together with lower rates, and this is what's going on now. Moving over to euro dollar quickly. Yesterday we stopped bang on this 38.2 again of the last leg higher. And saw a severe bounce that testifies that the euro is still very much in control of its fate, and we're seeing that on all the euro crosses again. Where am I? If you look at the euro Canada, it's absolutely non-stop. It's going and going and going, and we are closing in on a line here from 2015. 1, 2, 3, 4 touches. That's big enough to respect it, I reckon. So that's in around 153 quarters, where we are very close to. And then you have those stops here in the low 151s. They are perhaps also going to have a say in what's happening in the Euro Canada, together with what's happening in the oils and the commodities. For the time being, oil is not moving too much, but it's not bouncing an awful lot either. So we're still around 77.30 in the WTI, but that still testifies. I think, well, it's probably both. It's less hawkish Bank of Canada. It's a very strong euro. Its oil's coming off, despite actually not too bad Canadian data if you look at them. So for the time being, keep an eye on this. Not fighting it right now, but I'm starting to have a sneaky feeling that euro crosses on their own may, and it's conditionally, may put a topping very close to the ECB, maybe blow out in some of those pairs, and then start to come back post ECB, depending on what Mrs. Lagarde is going to tell us. Euro Aussie, same thing. Aussie also under the cosh versus yen versus even versus the dollar. It's trading at 66 a figure. We are very close to these 2020 October 2020 highs at 168.20. That's another, let's say 0.6, 0.7% to go. That could be enough. And if not this one, the 50%, although this is not an objective, this is a subjective high, right? Because nobody really knows the exact high of the pandemic or the exact extremes of some of those processes in the pandemic. Nevertheless, note this level. If ever it would really blow out in the next few days, 170.5. Another cross that's relentless still is the Euro Noki, but we are getting very close to those levels that Stel and I were already talking about. We are in the zone 1170, 1176. This is really where the thing should, in theory, stop if it has the ability for the Norwegian kroner to strengthen a bit. But watch out, we could have this quick blowout as well. It's the tiniest of positions. It's not really having a lot of impact on my P&L, but I've started to be very, very, very shyly short, but it just continued to go. So I'll be watching the clock this afternoon, because if Euronoki shows signs of topping out, this may be one to keep a very close eye on, this dollar Noki. If we are seeing the typical value date month end moves in the dollar, I'd love this to go and retest 1170. It's not that far, and it looks a bit far on the chart, but it's 0.6%. It's actually have the same move in the euro dollar that we have seen yesterday afternoon. At the start of the US session, we're back there. It's as simple. If you look at those at that candle, for instance, it did close to 1% in a little time. So ideally, we'd go up there for me, and then I may try to intervene a little bit. Yeah, this looks to be a pretty funky zone here on the dollar Noki. Right. What else? As I was saying, cable. It may be all month end, but then I'm looking at this cable. Yeah, we had those setbacks, and I am like everybody else. I'm not trusting Bailey at the Bank of England at all. I think it's one of the worst central bankers we've ever seen, and it also weighed on the sterling in a way. But this sterling continues to surprise perhaps people a little bit. So I'm going to be a keen watcher here. If ever we could have a setback this afternoon, back below, ideally back below this magnet zone of 124, 40, 50, closer again to 124, or just below. This could be an interesting zone to closely monitor. What else? Yeah, anything anyone wants to look at? I can show all those yen crosses, but we know what they are doing, right? It's broken down and really accelerated. We are on a small interesting zone here on the Aussie yen. But then when I look at what's happening on the yen right now, yen is just strengthening and strengthening again. It's perhaps not a right time to fight what's going on in the yen right now. But if you're short, keep an eye on this level, and it may be interesting to have a look at it. The Kiwi yen is a bit of a different one because we could argue it's still in its more medium-term channel. We had this dropout, and then the strong move back into it, and it's still wrestling with it. It's trying to break now, right? It's trying to break, so it could going to break. Like the rest of the yen pairs, I'm not inclined to try and bottom fish this one. But again, if you're short in it, it may be an area you want to look at. Khaled, I think we've already spoken about it. It's all end of month, and the euro strength. It's not euro exceptionalism, but if you look at the ECB expectations versus the Fed expectations, we've been talking about that for really a long time already, and that really explains a lot of what's happening in the euro and in the euro dollar and in the euro crosses. If you look at it on the little bit longer, if you look at the also already against the dollar, look at what's happened in the euro dollar. Look at what happens in the differentials. Half of your answer at least is there. Okay, so and again, well, today it doesn't move a lot, but I think today we are really in the end of month territory, which is keeping the euro and sterling underpinned today. Yeah, quick one on the dollar mix. Yesterday I was saying in the room, it looks a little complacent, the dollar mix right now. And if risk continues to feel the heat, this could be bouncing a little bit, in my opinion. It could be. But if you look at it, it's starting to really hold. Of course, if it breaks through 1790, lights out, and then we will be in for the next move lower. But that may be music for after the Fed, in my opinion. And there were also a few rumors flying around yesterday that Banxico may be in for a pause during their over their next meeting. And if we look at the inflation data, there may be enough reasons for the Banxico to start to pause. If you have interest rates of 11 or above percent and your inflation is running at 7.75%, I think the latest, it's perhaps time for the MEX to build in a pause. All right, that's about it. As we see, the dollar rand still in that range, but bouncing off 18. Ryan already spoke about the dollar China. I like this. I like it. I like this bounce actually. Not only the F.A.C.E, not only this range, but a nice 3-4 point trend line. And it's a decent break. But again, the dollar has some say in that as well. And perhaps for the end of the week, the end of the month, we could see a bit of a small different picture for the dollar. And that's it for me, Ryan.
Thank you very much, sir. And just a couple of comments. Michael saying earlier that iron ore and commodity prices are dropping, and that's keeping the Aussie under pressure. Yep, very much so in the mix as well. Sometimes you get more than one wind blowing at any one time, and that's probably what's happening there, and commodity currencies in general as well. Just back to dollar yen quickly. We are getting another move down. We've just moved down below these lows of the day so far. So keep an eye on that. The bleed still continues. If we do keep heading down, we've got this zone pretty much from 139 down to 132.80. So if we get down there, it may sort of be a similar looking story to what we got up around 134.30s. So just keep an eye on that area. If we do head down there, that might be a bit of a stretch point for this sort of moves, whatever goes on. Not too much data today. We've got the NBA mortgage stuff coming up in just over half an hour. Durable goods coming out as well, so keep an eye on that just for your data input. If it's really bad, then the dollar's probably going to suffer again, as will yields. If it's good, we might see a little rally in the dollar, but given the mood and what's going on during the last couple of days or this week so far, again, that might be something that gets hit by rally sellers in the buck. So keep an eye on that. And on that note, we shall call it a day. I'm going to be disappearing off later to the footy uptown. So be good. Don't break anything. Please join us on F.A.C.E a little later on, where you get the views from the master himself, coach, and all the rest of the team, no doubt. Thank you as always, Kay, for your valued input.
Cheers, mate. All the best at the foot.
Thank you, mate. And everyone, have a great day. All. We'll see you tomorrow.